The story you are about to hear is one of the most dramatic financial collapses of the modern era. A story filled with brilliance, ambition, greed, deception, and irreversible consequences. This is the rise and fall of Sam Bankman-Fried and the shocking implosion of FTX. To understand how a company once valued at over $30 billion vanished in 48 hours, we need to go back to the beginning, before FTX, before the fame, before the chaos. We need to understand the mind behind it all. Sam Bankman-Fried was born into a world of intellect. Both of his parents were Stanford law professors. His childhood was filled with books, debates, puzzles, and ideas. He was exceptionally smart, the kind of smart that makes people believe anything is possible. He went on to MIT, studying physics and mathematics. But even there, he didn't follow the typical path. Sam was attracted to a philosophy known as effective altruism. The idea that the best way to help the world was to earn as much money as possible and then give it away. After college, Sam stepped into the world that would change everything: cryptocurrency. In 2017, he created Alameda Research, a trading firm designed to exploit inefficiencies in crypto markets using advanced algorithms. One opportunity changed Alameda's fate forever: the kimchi premium. Crypto prices in Japan and Korea were consistently higher than in the US, Sam realized. Buy low in America, transfer coins overseas, sell high. In just a few months, Alameda made tens of millions. This success launched Sam's empire. He wanted more, much more. In 2019, he created FTX, a new crypto exchange. Unlike others in the space, FTX looked professional, safe, regulated. It quickly attracted traders, institutions, celebrities, and world leaders. Sam became a star, the crypto golden boy. His messy hair, t-shirts, and cargo shorts made him look harmless, unthreatening, trustworthy. Ironically, this image became one of his most powerful assets. FTX grew faster than any exchange in history. Millions of users, billions in daily volume, political influence, media attention, billboards, sponsorships, celebrities. Everyone wanted a piece of the revolution. But while the world celebrated FTX, a hidden crisis was growing behind the scenes. A crisis deep inside Alameda Research. Alameda had started losing money. Its once brilliant strategies were now risky, unstable, and increasingly desperate. And Sam made a fateful decision, one that would destroy everything. He allowed Alameda to borrow FTX customer funds. Not a little, not some, but billions of dollars. Customer deposits, savings, investments, life funds were secretly redirected to Alameda without user permission. This was illegal, hidden, and incredibly dangerous. But for a while, no one knew. FTX seemed unstoppable. Alameda looked profitable. Sam became a billionaire, on paper. However, the entire empire was balancing on a single, weak pillar, a token called FTT, created by FTX itself. FTT had no independent value. Its price depended entirely on trust. In November 2022, the world discovered the truth. A leaked balance sheet revealed that Alameda's assets were built almost entirely on FTT, a token Sam controlled. The illusion shattered instantly. Binance, the largest crypto exchange, announced it would sell all of its FTT holdings. This triggered a panic throughout the crypto world. Users rushed to withdraw their money from FTX. But when they tried, FTX couldn't pay. Withdrawals froze. Support vanished. The website lagged. And panic turned into horror. Inside FTX, employees were in chaos. They later described a collapse filled with shouting, fear, and confusion. No one even knew how much money was missing because FTX had no proper accounting system. Billions of dollars gone, misplaced, misused, lost. Sam made a desperate move. He contacted Binance and begged them to acquire FTX. For a moment, it seemed like salvation was possible. But when Binance saw the books, they walked away immediately. The financial hole wasn't small. It wasn't millions. It wasn't even billions. It was over $8 billion unaccounted for. That was the moment FTX died. In less than 48 hours, one of the largest crypto exchanges in the world collapsed completely. Users devastated. Investors ruined, markets shaking, global shock, and Sam Bankman-Fried went from hero to the most infamous figure in modern finance.
The collapse of FTX did not just shock the industry. It triggered an earthquake that rippled through the entire financial world. As bankruptcy lawyers stepped in, they began to uncover a maze of secrets, mismanagement, and decisions that no normal company could survive. For the first time, the world saw the inside of FTX. And what they found was worse than anyone imagined. There were no proper accounting systems, no risk management, no board oversight, billions moving between Alameda and FTX with no records, no controls, no documentation. Investigators described FTX as a complete failure of corporate governance and the worst financial record-keeping I have ever seen. But the most shocking discovery was the way Alameda accessed customer funds. FTX had a secret backdoor, a hidden mechanism inside its codebase. This allowed Alameda to withdraw unlimited amounts of money without ever triggering an internal alert. This wasn't an accident. It wasn't a misunderstanding. It was deliberate engineering, a quiet door in the system that only a few insiders knew existed. As this truth surfaced, public anger exploded. People whose life savings were on FTX realized they had never been safe. Parents lost college funds. Retirees lost savings. Young investors lost everything they had saved during the crypto boom. Meanwhile, Sam remained in the Bahamas, staying in a luxury penthouse worth tens of millions, purchased using FTX funds. He continued giving interviews, trying to control the narrative, insisting he never intended harm. But U.S. prosecutors saw through the performance. Sam Bankman-Fried was arrested by Bahamian authorities at the request of the United States government. He was extradited to New York to face federal charges. The charges were massive: wire fraud, securities fraud, conspiracy, money laundering, campaign finance violations, and defrauding millions of customers. During the trial, the inside world of FTX was exposed in painful detail. Former executives took the stand. Some had made secret deals with prosecutors. They revealed shocking testimonies, describing a workplace where billions moved with nothing more than a casual Slack message. One executive said, "If Alameda needed money, they didn't ask. They just took it." Another testified, "Sam directed it. Sam approved it. Sam was fully aware." The court learned about luxury real estate bought with customer funds, political donations disguised as personal gifts, private loans to executives worth hundreds of millions, and financial records stored in temporary documents that vanished. At one point, prosecutors showed messages where Sam admitted, "We are not very careful with risk management." He also described his own public image as a game, carefully designed to gain trust. But perhaps the most dramatic moment came when Alameda's CEO, Caroline Ellison, testified. She revealed the real numbers. FTX was hiding over $10 billion in liabilities. And she confirmed that Sam ordered Alameda to take customer deposits. The jury deliberated, and the verdict came swiftly. Sam Bankman-Fried was found guilty on all major counts. His empire had not just collapsed. It had been legally exposed as a massive fraud. The golden boy of crypto was gone, replaced by a cautionary symbol of unchecked power, reckless ambition, and catastrophic failure. But what does this story really teach us? First, trust is fragile. A friendly face, a humble persona, a casual hoodie, none of it guarantees safety. People trusted Sam because he seemed harmless. They trusted FTX because it looked professional. Both were illusions. Second, transparency matters. If you don't know where your money is already gone. No matter how confident the company sounds, no matter how big the marketing budget, no matter how famous their supporters are, transparency is the only thing that protects investors. Third, success hides risk. FTX grew fast, too fast, and rapid success often masks deep structural weaknesses. When speed outpaces oversight, collapse is guaranteed. Fourth, and perhaps most important, if something seems too good, too perfect, too polished, it probably is. The FTX story is not just about crypto. It's about human behavior, ambition, greed, trust, reputation, and the painful consequences of believing in the wrong people. For millions, the collapse of FTX was the most devastating financial shock of their lives. But for the rest of us, it remains a powerful reminder: your money is your responsibility, your research is your shield, and your skepticism is your best protection. As we close this chapter, remember, Money can be rebuilt. Trust cannot. This is the story of FTX, a meteoric rise, a catastrophic fall, and a lesson written in billions of dollars of loss. This is Money Master Files. Your understanding begins now.